You should spend every last dollar in your bank account before you die. At least that is the argument of the book Die with Zero, which is a best-selling personal finance / self-help book that has a pretty dramatic title, but a book that has genuinely transformed the way I think about how I spend my own money. So today I'll show you a few strategies that actually can help you essentially live this philosophy out and utilize your wealth today while also making sure you're not alive with zero in retirement. So I don't fully agree with every single detail in this book. There's one line and a quote that I will share here in a second that I think really summarizes the heart of the matter with this book. And it goes something like this. Having money helps you achieve the more important goal of enjoying your life, but trying to maximize money actually gets in the way of achieving the more important goal. And I think for a lot of the clients I work with, the goal isn't to die with $10 to $20 million and take just as low as possible withdrawal from your portfolio. I think the goal comes down to this. And again, I love this other quote. It says, choose what experiences make you happy and then convert your money into those experiences you choose. And I think that this is something that a lot of people will resonate with when it comes to the whole idea of early retirement, because that is ultimately a decision to start converting your money into the experiences that make you happy. But the caveat is that you just don't want to wait until age 65 to start doing so. So after reading the book, I think there are really 3 planning strategies that sort of embody the philosophy of getting the most out of your life with your money with the dollars you've saved. And I'm going to share them in this video. Now in the book, when he talks about dying with zero, it's because of spending all your money on the things and people that matter to you and getting the most out of your life. But as I mentioned in the beginning, I don't want you to be alive with zero. And if you have a bad investment plan, the chances of you running out of money involuntarily can go up. So what do I mean by that? Now, when you're growing your wealth, right, you're accumulating your money, you can usually get away with diversifying not quite as well as long as you're consistently putting money away and your dollar cost averaging into the market. In fact, when you're saving for retirement and the stock market goes down, that can be great because you're now buying more stocks at lower prices. But the math sort of changes a little bit when you actually retire, right? So in the book, it talks about when your net worth is its highest it will ever be. He's going to call this your net worth peak. Now, this is where the math sort of changes. You're now retaining your wealth and you're now actively spending money from your portfolio. If you're taking income out when the market is falling, this can sort of be a recipe for disaster if you don't have the right asset allocation, because being a forced seller of your investments that are declining is a bit like reverse dollar cost averaging, which we don't want to do if we don't have to. And in reality, the way you can build a portfolio that will help reduce the probability of being alive with zero and maximize your ability to continue have your money so you can spend what you want in retirement doesn't come down to being the next Warren Buffett. It comes down to having a portfolio with multiple return streams that perform differently at different market cycles. Things like real estate, commodities, international stocks, small companies, just to name a few, and having a nice buffer of conservative investments that can help smoothen out the ride. So when, not if, markets decline, you're not going to lose your shirt. Why? Because you not only have an emergency fund, but you have a war chest of cash and bonds in your portfolio that is there to help you essentially ride out the storm and let your money last throughout your retirement. For example, during 2008 and 2009, during the great financial crisis, the last thing you want to do was sell from your stocks. If you're well diversified and have a strategic allocation to cash and bonds, you can create your income from the assets that are held up well and actually have gained in value, as looking at this chart right here. Okay, now I've talked about this next strategy before, but naturally most people, when they're planning out an early retirement, they would use a simple 4% rule as far as a guide to help them with retirement spending. And I've even seen people use 3%. And although that is an okay back of the napkin starting point, what the research shows is that if you're willing to be dynamic, you can spend more than 4%. Because your retirement will have a big tie to the stock market, and you can actually capture higher income if you're willing to make adjustments. For example, someone who retired in 1986 with those markets would have drastically short-changed themselves with just using a 4% withdrawal rate. And again, in reality, most people have other income sources in retirement, and being dynamic is just a fancy way of saying when times are good, we'll take a little bit extra each month in income, but when, not if, times are bad, we will cut back until things get better. And the good news, the way this works in practice is just not making a massive adjustment like cutting your income in half. It's very small, 5 to 10% adjustments that can actually make a big difference over your long-term plan, since markets can go through downturns for a while, and we don't want to just blindly withdraw money and hope for the best. I view it as no different than if your job is going well and you get bonuses, you treat yourself, versus those times in life where you had to tighten the belt for a little bit while. So the approach that we follow is using a research-based guardrails approach, and you might have seen this on my screen in previous videos, but I think this approach really embodies the idea of thriving, not just surviving in retirement. And here's an example couple on my screen, not real names of course, but here is Mike and Sarah, and the hatchet thing you're looking at on my screen is their projected income sources over their lifetimes. And as we can see, they are working until around 2027. Now, by following this dynamic approach that takes into account all their income sources, such as you can see a rental income, a pension, and in the future, Social Security, which I'll talk about later in the video, you can start your retirement by fully funding it through, a majority funding it through the portfolio. And you can take that higher percentage withdrawal rate, higher than 4%, which would normally be deemed acceptable because we're sort of front loading retirement spending when you're in the go-go years. And then we can expect them to have their highest spending now versus in the future. But as we move along in life here, Social Security is eventually going to come in and act as essentially your longevity insurance for those slow go and no go years, which I'm actually going to talk about how that exactly works next. And that's where you can see the drop here. There's going to be a big drop in portfolio withdrawals because you now have Social Security to really make up a majority of your income, and your income is less dependent at the stock market at this point. So again, in their scenario, this initial withdrawal capacity is closer to 5%, which allows them to retire earlier, assuming we are invested properly and we have the right accounts in place, and we're willing to be also dynamic. Okay, so let's talk about the third strategy here, which comes down to how you utilize Social Security. Now, I made a video on how your Social Security benefit will be reduced if you retire early. And like I showed in the chart earlier, one way to help reduce the impact of less earnings years is by simply spending down other assets and delaying your benefit. And if you don't already know, you essentially get an additional 8% bonus each year after your full retirement age. And in the end, this is just a guaranteed rate of return backed by the federal government. In fact, the implicit return of delaying Social Security is not just a nominal return, it is also a real return because these benefits are adjusted for inflation annually. So Social Security and the decision to delay benefits represents a pretty unique form of longevity insurance, which the book talks about, and is a return that is contingent not upon interest rates or market performance, but survival and longevity. Now again, the reason this can be delayed is that you have the portfolio assets to bridge the gap. However, this is something that at the end of the day might be more of a peace of mind decision versus a numbers driven one, and I completely understand that. I mean, you might be concerned that you might not live long enough to make the delaying of your Social Security benefit worthwhile. But while I would hate for you to have left money on the table, if that indeed happens, the main hedge here is concerning what happens if you live too long. The good news is that Social Security has a 6-month look back, which means that if in 6 months later after you're eligible and you still feel like claiming benefits, for example, because of a change in health or a serious change in market conditions, and you feel like the right decision for you, you can always file a retroactive application with the Social Security Administration to basically claim benefits as if you started today. Now, how that works is that they'd send you a check to essentially catch you up on the payments that you missed, and after that, you would receive checks for life as if you claim your benefits today from the beginning. Otherwise, you can continue to delay filing for another 6 months and then further repeating the cycle until you either decide to file or you reach age 70. At that point, you have to file anyway. But at the end of the day, you will have to plan for lower Social Security benefits if you retire early. So I made a video on how your benefits are impacted if you don't work more than the 35 years that were required as far as the calculation they use to maximize your benefits. And you can watch that video by clicking right here. Once again, this is Matt Calcagno over here at 1 Degree Advisors. I hope you get the book. I hope you read it. Maybe it's going to change your mind. And I hope you found value in this video. Thank you for watching, and I will catch you guys on the next one.